We have got the big one on our desk today. The U.S. Bureau of Labor Statistics December Consumer Price Index.
The CPIU.
Exactly. You've given us the source data, and our mission, as always, is to cut right through it, find the key movers, and really just get you the insights you need without any of the fluff.
Right. We're here to give you that shortcut to being instantly well-informed. And, the headlines all focused on that steady year-over-year rate.
Mm-hmm.
But the real data, it tells a much more nuanced story about where prices are actually gaining steam and, interestingly, where they're collapsing.
And that nuance is everything for understanding where the economy is headed this year.
It is.
So let's start at the top. The big numbers, seasonally adjusted. The CPI for all urban consumers, it rose 0.3% in December.
Which is a moderate jump.
A moderate jump. And if we look at that unadjusted 12-month rate, the big year-over-year number everyone watches, it held steady at 2.7%. Same as November.
And that stability, that 2.7%, is actually where the surprise was.
Oh, interesting. How so?
Well, the market was bracing for a hotter monthly number. But when you strip out food and energy, what we call core CPI,
right,
both the annual and, I think more importantly, the monthly rate were actually lower than expectations.
Okay, so the underlying trend is cooling.
It is, but it's being dragged higher by some very specific, very stubborn sectors. So we need to find out what those anchors are.
All right, let's do that. Let's unpack that 0.3% overall monthly rise. If the core number was lower than expected, something specific must have done the heavy lifting.
It did.
What was the single biggest contributor in December?
That distinction, it overwhelmingly belongs to the housing index.
Of course.
It was up 0.4% month over month.
Yeah.
It was the single largest reason for that entire inflation print.
Mm-hmm.
Shelter costs just continue to be this immovable object.
That makes sense. But let's break down housing for a minute, because the core index without food and energy only went up 0.2%. So housing really is the anchor here. What are the shelter components?
Absolutely. So inside that 0.4% jump for housing, you've got both the rent index and owner's equivalent rent OER.
OER.
And they both increased by 0.3% in December. Now, for anyone new to this, OER is how the BLS estimates what you as a homeowner would pay to rent your own home.
It's an imputed cost, not a real one.
Exactly. And because of that, it moves based on a lagging average of leases. So shelter inflation is basically running on last year's contracts. That lag, that's the mechanical problem the Fed is facing.
So that's the stickiness. We're still feeling the heat from leases signed 6, maybe 9 months ago.
That's it. But within housing, there was one number that just jumped off the page, a sort of seasonal spike.
What was that?
Lodging away from home. So hotels, it soared 2.9%.
Wow, just in December.
Just in December. Clearly, holiday travel played a massive role there.
No kidding. So to understand why that core number stayed down at 0.2%,
right,
we have to look at the other side, the deflationary pockets. Where were prices actually falling?
We saw some pretty big drops, especially in goods and tech. The communication index, for example, had a sharp decline of 1.9%.
Okay, so phones, internet plans, that kind of thing.
Yep. And used cars and trucks, that index kept falling, down another 1.1% for the month.
That's welcome news.
It is. And household furnishings and operations, think appliances, sofas, that decreased by 0.5%.
And what about new cars?
New car index was flat. No change.
So the story for the core is really cooling goods versus super sticky services, all anchored by housing.
That's the structural split in the economy right now. That's what the Fed is wrestling with.
So we need to move beyond the core and look at the categories that saw the most, memorable movement, the real aha facts.
Exactly. Let's start with the stuff you buy every week.
Food. The food index was a huge factor in December, up 0.7%. And what's crucial is that it was basically the same for groceries and restaurants, both up 0.7%.
And in the grocery aisles, what stands out is that 5 of the 6 major categories went up. Dairy was up 0.9%, cereals and baked goods up 0.6%.
But there was a real spike somewhere, right?
There was. It was in the catch-all other household food category. That one spiked 1.6%.
And what's in that?
That's things like sugar, sweets, fats, prepared foods. Things where processing and packaging costs are a big deal.
Got it. But amidst all that, there was one hero item. One thing that saw a massive drop.
Oh, we have to call this one out.
The eggs index.
It fell a staggering 8.2%.
Just in December.
In 1 month. It's a massive downward swing. It just shows how quickly prices can correct when supply chain issues, like the avian flu outbreaks, finally stabilize.
Localized supply and demand right there.
In action. Now, speaking of rapid action, we have to talk about leisure, recreation. This number is, Well, it's historic.
Really? What happened?
The recreation index jumped 1.2% in December. The source material notes this is its largest single-month increase since the index was first published.
Since it was first published, when was that?
1993.
Wow. So in over 30 years of tracking this stuff, we have never seen a monthly spike that high for recreation.
Never. It signals this massive, sustained demand for experiences. People are prioritizing spending on quality of life services over just buying more stuff.
And they were traveling to do it, it seems.
They were. The airfare index jumped 5.2% in December. Classic holiday demand.
And what about the less fun services? Healthcare.
Also up, the medical index rose 0.4%. The big pressure point there was hospital services, which was up a full 1.2%.
Healthcare is always that steady upward pressure, isn't it?
Always. It doesn't really care what the Fed does.
Okay, let's pivot to the other really volatile area, energy. The overall energy index was up 0.3%. But that number hides a really different story.
It really does. It's a tale of two energy sources.
Heating your home versus filling your car.
Exactly. The natural gas index jumped a huge 4.4%. Colder weather, higher demand. But at the pump, consumers got a break. The gasoline index actually fell 0.5%.
So that overall 0.3% rise in energy is entirely about utilities.
It is. The globally traded commodity, gasoline, was going down, while the cost to heat your home was spiking. And that brings us to the long-term trends. We need to zoom out.
Right. Put all this monthly noise into the context of the full year, the 12 months ending in December.
And that annual view, it confirms the cooling trend, but it really reveals those structural weaknesses. The overall all items index came in at plus 2.7% year over year.
And the core index.
Just a little lower, plus 2.6% over the 12 months. Food was up 3.1% annually, and the broader energy index was up 2.3%.
Okay, let's stick with that 2.3% YOY energy figure. You mentioned the monthly split. What does the annual divergence look like?
It's even more dramatic over 12 months.
Okay.
When you look at utility inflation, electricity is up 6.7% for the year, and natural gas is up a massive 10.8%.
Double-digit inflation for heating your home.
Exactly. And in stark contrast, the gasoline index is actually down 3.4% over that same period.
Wow. So the pressure has completely shifted from the gas pump to the utility bill.
Overwhelmingly. And utility costs are much stickier. It's harder for a consumer to just, substitute away from them.
That's a vital point. So moving back to the core items, what else showed those big, persistent year-over-year increases?
Well, housing, again, was up 3.2% annually, but a few other categories were even steeper. Household furnishings and operations, despite the monthly drop, is still up 4.0% for the year.
Okay.
Personal care is up 3.7%, medical care up 3.2%. And that big monthly mover, recreation, is up 3.0% annually.
It's all services, isn't it?
Almost entirely services and non-durable goods.
And the annual food numbers, I bet there are some interesting details there, too. People are still feeling the pinch when they eat out.
Absolutely. The food away from home index, that rose 4.1% over the year.
And can you break that down?
Sure. Full-service dining, so sit-down restaurant, that saw a 4.9% increase. Fast food was a little lower, but still up 3.3%.
In the grocery store.
Non-alcoholic beverages showed a 5.1% annual increase, and the big meat, poultry, fish, and eggs category was up 3.9%.
Was there an annual decline in anything? Did any big grocery category actually get cheaper over the whole year?
Yes. One did. It was a slight one, but the dairy and related products index actually saw a 0.9% decrease over the past 12 months.
A small bright spot. Okay, let's wrap up with a quick run-through of the technical indices for those who need them for, say, contracts or salary adjustments.
We must. The unadjusted CPI-U, the standard one, was flat in December. It's at an index level of 324.054, with that 12-month change of plus 2.7%.
And what about the CPI-W for urban wage earners?
The unadjusted CPI-W actually fell a bit, down 0.1% in December. It finished the year up 2.6%.
Okay.
And finally, the chain CPI, the CCPIU, which accounts for people substituting cheaper goods.
Buying chicken when beef gets expensive.
That's the one. It was also down 0.1% in December for an annual increase of 2.5%.
Got it. Thanks for the technical details. And just so everyone can plan, the next CPI release for the January data is scheduled for Wednesday, February 11th, 2026 at 8:30 a.m. Eastern Time.
Mark your calendars.
So if we pull this all together, what's the central story of this deep dive? For me, it seems to be that inflation cooled more than expected in the core, which is the good news.
Right, that's what the market liked.
But consumers got absolutely hammered by housing costs, which we know are lagging, and by very specific high-demand services like recreation. It was a month of cooling goods meeting stubborn services.
That's it, exactly. And that brings us to our final provocative thought for you to take away from this. Given that the data shows the biggest annual energy price hikes are coming from utilities.
Right. Natural gas up over 10%, electricity up almost 7%.
While gasoline is actually down 3.4% for the year.
Mm-hmm.
How might this impact household budgets differently?
That is interesting because gasoline prices are volatile. They're on big signs everywhere. But utility bills are sticky. They're non-discretionary. They just raise the baseline cost of living in your home.
It's a quiet tax.
It's a quiet tax that's much harder to escape than high prices at the pump. That's the thing to watch moving forward.
Indeed. Until next time.